Hey guys, what's up, how's it going? Welcome to another video on the channel. So in today's video, we're going to do a quick little update like we usually do. I'll go over all of our accounts and we'll do our monthly update. So it's been a little bit since I've done a video for this channel. Do apologize guys, it's been a pretty busy past couple months here. And I don't 100% remember when the last time was I did a video. I think it was either February or March. So obviously a lot of things have happened since then. So we'll kind of go over these different things here. I'll kind of give you guys a quick little recap of what's happened, what our plans have been, and of course I'll give you guys an update on our holdings. I'll give you guys an update on our dividends and all that kind of cool stuff. And I'll show you guys some thoughts and stuff like that, since a lot of things have kind of happened since I did the last video, which with the little dip we had in the markets, the tariffs and all that kind of stuff. So I'll give you guys a quick little overview of that, and I'll show you guys what we've been doing. And all you long-term followers of the channel can probably guess that it's been the same old. That's kind of what we do here, is we just kind of keep doing the same thing regardless of what's going on, and I'll show you guys why that's so important to do. So quick little overview here. Here's our accounts. Actually, here's my account. I'll show you guys my account, then we'll go over and I'll give you guys an update on passive to show all of our accounts. This would be like me and my partner's accounts all together. You guys can see our total holdings, because I don't think I've done an update on that for a while, and obviously things have changed a little bit. So you're seeing here on the main screen my main Wealthsimple account. This is on the desktop version, so if you guys have a PC, this is the desktop version of Wealthsimple Trade, and this is all my accounts here. This is my TFSA, my First Home Savings account, my RSP, everything combined together here. So let's go over this really quickly. We have $188,000 in total. 1 month return is going to be up 9.72%. So the last month has been a bit of a rally, which, when the tariffs were announced, people weren't sure about things. Here's the thing: whenever you get like a big dip in the market or something's going on with new stuff, you never know what's going to happen. Some people are going to say it's a doom and gloom and everything's going to crash and you should sell everything, and people panic. But hopefully you guys know better than that. And one thing that going through multiple scenarios like that, since I first started investing way back in 2019, is that markets always go up eventually over time. So whenever that happens, is just keep doing what you're doing. In fact, what you can do is you can even like double down. As long as you're buying like good funds and you're buying the market and stuff like that, you really don't have to worry about like really what's going on to really mess up your portfolio, at least in the long term, right? Maybe in the short term it does, but if you're buying individual stocks, things can get a little bit tricky, because some things going on in the world can affect individual companies, and that can have an effect. But if you're just buying the market like we do, where we have like the S&P 500 Canadian fund, and it's pretty simple like that, you can feel safe about like, you can put your money in, and eventually over time it's going to grow and it's going to rebound, and when it does, you guys are going to get a nice chunky reward, and the more it dips, the more it drops, and the more you can put in, the more benefit you're going to gain. And one of the things we did, and I told myself, is when the tariffs were initially announced. So I'll show you guys a quick little overview here. So let's go last 6 months here. So we can see, like, I think it was here in the beginning of April that the whole tariff thing happened. We can see that the stocks dropped quite a bit. Right around here when this happened, I kind of told myself, you know what, we're going to focus on saving money, because budgeting is a thing that people don't talk about when it comes to making money in the stock market. But one of the biggest things, like obviously buying good quality funds, but that's pretty simple. Everybody say the same thing, buy the S&P 500, buy a fund, buy an index fund, buy, a global one if you want like diversification, all that kind of stuff. Pretty simple stuff. That part's easy. But the big thing that people don't talk about is save the money. Budget the money, save the money, because the more you put in here when the markets are going down, the more they're going to go up and benefit, because everything I saved here and put in during this whole period of time, it all benefited, plus the dividends and everything being reinvested. So we focused on that. That was a big thing I told myself, was like, we're going to save, we're going to try and be even extra frugal, just at least for that period of time, just to take advantage of it. But the last month or so, we're up 9.72%, so quite a big rally there. That's about $16,000, so quite a bit for a big portfolio. If you guys are just starting out and just getting started with investing, you might be in the green, you might be in the red. If you're probably just getting started, you might be in the red still. But one of the benefits about having a portfolio over a long period of time is that even during these dips and stuff like that, you're still going to have a nice gain. You're going to still be in the green, so you can get really comfortable. And it's just something you just have to go through to have the confidence and keep going with it. Last 3 months, we do have a little bit of dip, so we're not 100% recovered since the U.S. market kind of dipped. And the main reason why is because we're so heavily invested in U.S. funds. Big chunk of my portfolio is in the US market. So the US markets are not 100% recovered, but they're pretty close. Canadian markets are actually doing quite well right now, a little bit higher, nothing crazy, but they are kind of recovered a little bit. And I do think this year is going to be a good year for Canadian stocks. But we'll have to see. Nobody can predict what's going to happen. We could see everything drop quite a bit this year, or we could have a really crazy year again, or it could just be kind of neutral and flat. Nobody really knows. That's something I've learned over time as well. But the past 6 months were pretty much 0%, no big gain or nothing like that. Pretty much just stay in the course, just keep putting things in. Year to date, same thing. We had a bit of a jump at the start of the year in January, bit of a dip, and now we're kind of back up to even. That's just how the market goes. And like I said, guys, just got to keep putting money in, and that's where you're going to get the biggest benefit here. 1 year return, so this would be year over year. So May 2024 to May 13th of this year is going to be a gain of 12%, 12.64%, which is $21,000. It's actually crazy to think that it's that much, because I remember when I made this portfolio. If you go back to my older videos, I remember when I made those old videos when I had like, a couple $1,000, $10,000, 15, 20, 30, 40, kind of just rose over time. You don't see like a 10% gain might only be like $1,000, but when your portfolio really starts to grow, it's actually quite a bit. It's crazy to think. But that's just goes to show you, like, if you put in the hard work, you'll see that. And then all time, you guys can see, since we first started investing, it's just been a pretty steady rise, more or less. Lots of ups and downs, but generally trending upward. And anytime there's a dip, we always keep going. We keep hammering down. When everybody else is freaking out over the markets, just keep putting money in. As long as you're buying good quality funds and you're diversified to some degree. And when I say diversification, I mean like you're buying some ETFs, some funds. Maybe you're, so you're diversified against sectors. Maybe you're, nationalities, like different countries and stuff like that. North America, Canadian, US. Maybe you want some European stocks. It's up to you guys. But as long as you guys have a little bit of diversification, you can just keep staying the course. And as markets go up and when they recover, you'll be rewarded with a nice little growth inside your portfolio. And that's just from a stock growth perspective and a total return. That's not even to talk about the dividends, which we'll talk about later on in this video. So zooming down here, here's going to be the individual accounts. So I can show you guys the accounts we have here. We have the TFSA, the First Home Savings Account, and an RRSP. My TFSA is maxed. I maxed it, I think it was last year or the year before, I don't remember. But it's basically, my TFSA is a flexible account for me. It's a growth account predominantly because I want to make the most growth as possible. Because again, it's tax-free. The TFSA is probably the big focus most people should focus on because it is a tax-free account. Obviously, the RSP does give you pretty good benefit, especially if you're a high income earner or you just have the free cash. And I'm going to talk about that later on in this video because we did put some money into our RSPs, and the money we put into our first home savings accounts did really benefit us during tax season. We got a nice chunk of taxes back, and we actually made money just by moving money around. So that's something we'll talk about when we get to that later on in the video. But the TFSA is such a good flexible account, and this is kind of how I run it. As I have our big main growth ETFs, so like the VFE S&P 500, VOO would be the USD version of it. There's lots of different versions of the S&P 500, but it's basically Vanguard's version of it. Obviously, this is about, if I remember correctly, it's about 60 to 65% of the portfolio. I can't remember. I think it's about around 60 or so. So it's quite a big chunk of the portfolio. And then we have VDY, which is a Canadian dividend stocks. This is dividend plus growth. This is our Canadian exposure. It's about 20%, I think, give or take. Then we have some individual stocks, and then we have some income. We have some passive income here, like HYLD, HDIV, and FTN. These are our income funds. Reason for this is I've been experimenting with the high income covered call ETFs as well as some split share corps. They're very small holdings. They represent about like maybe, I think, 2 to 5% of the portfolio, each individual one. So it might be like 10 to 15%. But they bump up the income of the portfolio and they give us that cash flow. They help give us cash flow and it's tax-free as well. And I've kind of been experimenting with them to see, can you get growth off these funds? Can you get a good return? And the answer is yes. I tend to buy them when the markets dip. When I see markets drop, I tend to buy a little bit more of the covered call ETFs. That's when I kind of bring up my holdings to what I want them to be. Because then you can buy them during the dip and you get that nice capital gain plus the nice dividends and stuff like that. But, you guys can do whatever you want to do it. That's just the way I do it. One thing I do want to point out as well is I did sell some individual holdings. Over the past couple months or so, I've been moving away from individual stocks. depending on how the markets have been doing, I have been selling them. So, if you guys watch my channel, and you're a longtime viewer of the channel, you might see that I don't have a lot, like I sold my TD stock shares. I sold that because they were doing really well and I wanted to move away into ETFs more. And a lot of these individual stocks, like I think the only ones I have is TELUS and CNR and ATD. I will be moving these into funds, at least in my TFSA. And I think that's going to be, for the most part, the route I'm going to take. I'm just kind of waiting for TELUS to kind of rebound. I don't know what TELUS is going to do this year. I've got a little bit of a gain back, but we'll see kind of thing. I might hold on to that for a little bit longer. Same with CNR. We'll kind of see how things go, but I am going to eventually move these into ETFs, at least for most of my accounts, and just keep things simple. For a couple of different reasons. Number one, the biggest problem I'm having with these individual stocks is like a stock like ATD. It's hard to know when to sell an individual stock, right? Like a stock can go up a lot. It's hard to know when to sell it. It's a pain in the butt to kind of keep track of it. And when you have multiple accounts like I do, it just want to simplify things across all the accounts. So that's the focus I think I'm going to take. Here's the First Home Savings account as well. I've kind of adjusted my allocations as well to be a little bit more growth oriented in some accounts. Like the First Home Savings account is going to be much more growth oriented because the whole idea is to grow the money for a down payment for a house, and houses are expensive here in Canada, as I'm sure all you guys know. They're absolutely ridiculous. So the idea here is to grow this account as much as possible. TFSA is a flexible income account plus growth, predominantly growth. And then the RSP is, again, very much focused on growth because you want that to grow long term. And the RSP, in reality, we're not going to be touching this account for a while. We could use this for a down payment for a house. There is some different benefits you can use it for. You could use it to go back to school, which is, for education, which is something that's been on my mind, which I could do down the line. And you can use it for, I don't think if there's anything else, like I know you can use it for for paying for a house and stuff like that. But you could always just take it out whenever you want. Like you could keep money in RSP for like 10, 20 years. Then take it out if you want, depending on where you're, how you feel about it. It's just you ideally want to keep it as long as possible and keep it growth oriented. So that's kind of what we're doing with that. But when we do buy a house, we'll probably use our First Home Savings account. We might use our RSP, depending on some things. And we'll talk about that when we get there, kind of thing. I've been doing a lot of my research on this stuff. But one of the big things we have done during our tax season was me and my fiance each put money in our First Home Savings account. We put money in RSP, and we got a big chunk of tax money back. So you'll probably notice when you go to passive, you'll see we put a lot of money in our accounts over the past couple months, and that's the reason why. We took some money. We basically took some money out of my TFSA, and my fiance had some money saved up. We put in those accounts, got the tax benefit, and we generated income just by moving from one account to another. And we'll talk about that a little bit later on. But that's a quick little recap there. Let's head on over to passive, and I'll show you guys our entire stock portfolio. Here's our passive account, which we'll go over here in just a second. And I don't know if I mentioned this earlier. Actually, you can see a nice little graph here on the right side. I'll scroll up here so you guys can see. This actually highlights, what's happened in our portfolio. So in April, we did see quite a bit dip in the market. We were sitting at a portfolio high sometime in February, March, about $245,000. We were putting money in, market dropped, right? We went down like everybody else. I think I lost like somewhere around like $20,000 to $30,000 or something temporarily. It was quite a big chunk there right when the tariff thing was announced, but we kept putting money in. I just want to highlight this again because it's so important. We kept putting money in, markets kind of stabilized, things go back up, and now we're at an all-time high of just shy of $250,000. So, once again, guys, just put the money in, keep focusing on it. Don't worry about what everybody else is doing. Don't worry about, the markets and the news and all that kind of crap and what people on social media are saying. They, for the most part, other than, the exception of a few people, it's just all noise and a lot of people don't know what they're talking about. Just stay the course, keep doing what you guys are doing and adjust things over time to, your liking in the way you do things. That's kind of what we've done. It's worked pretty well for us. Here's our last contributions over the last 12 months. So ignore this big number. It's not accurate. Passive doesn't track when you move money from one account to another. So these big contributions of like 20 grand in December and January, this is just us moving money from my TFSA into other accounts and stuff like that. I was moving money for tax reasons and stuff like that, moving money into my RSP, moving money into my First Home Savings account from my TFSA and some other accounts and some cash we had. So it doesn't count the withdrawals. So this is not accurate. It looks like a lot of money. It's not accurate. It's more accurate to this. So in February, we put $3,000 in. We saved up a lot of money in February. We've been grinding again the past couple months. And the main reason why is because we're thinking about, me and my partner are thinking about the next few stages in our life, things like buying a house and stuff like that. So we're kind of back on the grind a little bit, saving money when we can. We're both working full time, which has made a huge difference. And yeah, we're just kind of trying our best to get ahead, and you'll see the compound growth, right? Like the compound growth of the dividends and stuff like that. And I got a cool milestone for our dividends, which I will show you guys in just a second as well. March, we put $1,600, and then April, we put $4,000. This was some of our tax money. So we got some of our tax money. We're still waiting on some money to come back. But we got a good chunk of money in taxes back. And then May, we put $1,700 already. And again, most of this is our tax money coming back, and then we're just keep saving. We're just saving, and we're grinding away because, you know, we do want to get ahead. And, you know, once you get that snowball rolling, you know, it just gets easier as time goes on. But again, you know, everything is expensive. The biggest problem I think a lot of people are facing right now is housing. Housing is so damn expensive in this country. You really need to work hard, and that's kind of where we're at right now. Is if we can get the housing kind of thing figured out, then at that point, the rest is all gravy. But it's tricky right now. For if you're young, you're just getting started, and you don't have a house, and you don't have all that stuff, it can, especially if you don't have help, it can be really hard right now. So I definitely feel for a lot of people experiencing that right now. But if that is you, just keep working at it, keep going, guys. You'll get there. Here's our different accounts we have here, and important to use all the tools that you can available. Use your first home savings account, use your TFSAs, use your RSPs if you have to. All that stuff benefits, and if you can get a, you know, find somebody that you can work together and build a future with, because that makes things a hell of a lot easier. So here's our different accounts here. We have our first home savings account. Here's mine, about $13,000. I put the $8,000 in last year, and I've been kind of topping it off as time goes on. My TFSA is maxed at $163,000, as I showed you guys. My RSP, about $12,000. My partner's TFSA is what we're working on predominantly right now. My girlfriend still has tons of room in her TFSA, so we're kind of focusing on that. It's kind of split between her TFSA and my first home savings account, and then we have her first home savings accounts. She maxed it out at the end of last year, and we got to claim that on our taxes. And what we'll probably do is wait to the end of this year, and come like December or so, before the cutoff is, I'll top up my first home savings account if I need to top anything up, and she'll top hers up. So we get that nice tax benefit, and we'll see about putting money into the RSP or not. Kind of depends on where we're at, how much money we made, and all that kind of different stuff. So that's the accounts. That's those accounts. Quick little overview for you guys. So super pumped. Obviously things are growing regardless of what's been going on. And we're just hammering away here. So the portfolio, even though it's been doom and gloom, we're at all-time highs. And again, that's the compound craziness of investing into stocks. So let's go reporting here on passive. Let's go all-time. Give you guys a quick little overview of some things here. Let's go to the dividends. So as you guys can see, our dividends, I like to track the dividends. It's another tool that you guys can use to track your progress. So when the markets are going up and down and you're not too sure, or it's giving you a headache, or you're just getting stressed out from it, focus on the dividends, because dividends, you can kind of comfortably rely on them to grow. And as you're putting money in, you'll see that consistent growth of dividends. If you're investing in good quality companies that don't decrease their dividends, you want companies that are increasing their dividends, good quality companies, you'll see those dividends grow. So it's like, imagine getting paid a little bit more every single month. Like if you worked at a job, getting raises every single month, it feels awesome. It's a good thing. And it's a good thing, I think, for beginners to focus on. And I think it's a great tool. So like why a lot of people like to focus on this right here, which is their total growth, which is going to just move up and down with the market. Another cool thing you can focus on, especially for beginners, is your dividends, because you can see the growth and the market won't affect your dividends. Like if you put in $1,000 today, even if your portfolio goes down, next month you're going to be making more dividends. So that's the cool thing about dividends, and the increase over time. So you can see that growth. Here you guys can see the years. So 2020, pretty small year in dividends. 2021, you made about $1,000. 2022, 2,000-ish, a little bit shy of 3,000. 2023, 4,000, shy of 5,000, and then 2024, 6,000, and then in 2025 we're at 3,671 already, and we're not even at half the year. So it just keeps growing and exponentially growing. Here's a quick little overview. I'm going to show you guys monthly. See if I can find the monthly update here. Actually, we'll go year to date. for our dividends. So you guys per month, and we hit a new milestone for dividends for April. It was a really good month for dividends. Keep in mind, we did get our quarterly dividends from our ETFs. So we have like the S&P 500 gives us, because we have so much in there, we get a nice big dividend chunk every quarter or so. But January, we got $885, really good month in dividends. February, $539, March, $600, April, $1,000. We hit $1,000 in dividends. First time we ever hit that in a portfolio. I was pretty happy about that. I know it's silly, it's small, and it's not even that much. If you look at like, if you look like over the 1 year return, right, for a portfolio, let's go on Wealthsimple just to give you guys a quick overview. Like 1 year we made like $21,000. It's probably around like passive with all of our accounts, it's about $33,000. So it's like, yeah, $1,000, big whoop, right? But it's just something that, like, because you're getting it cash and it's independent of the market, it's so nice to see that, and we worked so hard for that, and it's cash flow, right? Like if we ever needed the money to use for whatever reason, right, to help pay down a mortgage, to help pay for a car, to help pay for insurance, to help pay for food or groceries or anything like that, to help pay for vet bills, anything that comes up, it's there. So it's just another tool that you can use to keep your head in the game and keep working at it. So yeah, and again, you guys can see like over time, like it's just been a slow increase in dividends, right? Like every single month we put money in, it's just steadily growing as time goes on, and you'll get the compoundingness, right? Dividends buy more shares, companies increase their dividends. I haven't done a video where I track the dividend growth yet. I'll probably do one. I don't know if I did one yet for this year, but maybe next video I'll do a video where I show the dividend growth. But we do see steady dividend growth, especially with the ETFs. And our total dividend income all time, you guys can't see the number because my webcam I think is blocking it, but it's about $18,000. We made 18 grand in dividends. So it's really starting to rack up here, which is super cool because I love that idea of, like, you know, using that income for different things and stuff like that. So that's a quick little overview of that. Hope you guys enjoyed that. Last thing I'm going to do before we end the video is going to give you guys a quick little overview of our expenses and stuff like that, and then we'll jump into Wealthsimple and I'll show you guys our entire stock portfolio. All right, so here's the dividend income and budgeting spreadsheet. I don't think I've done an update for last month, but I'll just give you guys a quick little update on this because it is something that I think is very helpful for a lot of people. So the idea here is to eventually use our dividends, like I mentioned. Remember, I think we make our 3-month average, I think, is close to $500 to $600. So I'm gonna have to update this because I don't think it's accurate. But this is just a way for us to track our income. So we roughly make about $6,000 a month, give or take, in income between the two of us. And this is just work income. This isn't like income from investments or anything like that. So just kind of keep that in mind. And our income does fluctuate quite a bit because I do work from home part-time. So like some months it's a little bit higher, some months a little bit lower, but obviously, you know, I think it might be like that for most people, right? But the idea here was to use our dividend income to pay for our different expenses. And the thing here is we made a list of expenses of pretty basic necessities that we use in our life. So we have things like our recreational things, we have things like our car payments, our internet, our phone, our gas, our rent, all these different things. And the idea is to use our dividends to pay for these things. So our 3-month average is about $670 on dividends. And what we want to do is we're kind of just playing around with this. This is just kind of, we reinvest our dividends. I don't use them to pay for anything if I don't have to. But the option is there just in case. And down the line, we do want to use our dividends to help pay for things, so that we don't have to wait till like we're old to enjoy our money, right? We kind of want to get the benefit of it as time goes on, because the way I see things is we're probably going to get to the point sometime when we get older where we're just going to have so much money, we're not going to know what to do with it. Like, you know, like when you start saving and you start investing and you're really good with money, I think this is something that happens to a lot of people. And I struggled with this as well, is that you get into saver mode and you keep saving, and it's great in the beginning, but like when you kind of zoom out, I do see a lot of people kind of move on and they have a lot of wealth that they never used, and you can't help but think that maybe they could have benefited a little bit, you know, throughout as time goes on. And that's what we're using. That's what our income funds are for. That's what our dividend stocks are for. It's to kind of allow us to tap into some of these things that maybe we wanted to have at a younger age, or just to make our lives a little bit easier where it really matters, right? So here's a list of different things that we have here. So we tallied up our total expenses. I haven't updated this number for a while, but I don't think for the most part anything has really changed. So it's about $2,000, $2,400 is our total expenses, give or take, rough estimate. It varies, but that's give or take what it is. And this is what our dividends are. right? 3-month average 670. I'm gonna have to update it for this month because we obviously made quite a bit. This number right here, this green one, is basically what our dividends are currently covering. So we could probably add a couple more things to the list, obviously, because if our 3-month average is 670 and we're 494, we could add a couple of things. So we could maybe, add gas, where we're pretty much paying for our gas. The green items here are the items that the dividend's already paying for. So the big ones are going to be groceries. Big one is rent, right? We actually have relatively cheap rent for where we live because we lived in the same place. But our internet, we could use it to pay for our internet. But the idea here is just to pay for our essentials and force us to budget. If anything, at least this forced us to sit down, make a budget, see where our money is going, because that's such an important thing. It's so easy to spend money nowadays and not even realize it. With credit cards and subscription services and taps and stuff like that, it's so easy to just fork out money and not even realize at the end of the day you spent all your paycheck on like something stupid. Like, it's so easy to do that nowadays. So it's important to track your money, and we're not perfect with this at all. I spend money on things, and I always overdo my budgets most of the time, but the idea is to just try to stay close as possible. So quick little overview of that. And the last thing I'm going to give you guys is a update of our individual stocks on Wealthsimple. Alright guys, last part of the video. It's been a bit of a long one since I did want to cover a bunch of things here, because once again, it has been a while since I did an update on these videos. I think it's been a month or two at least. So I just wanted to do a nice thorough update for this month, and who knows, maybe it'll be, once again, I try to do these updates on a monthly basis, but sometimes it can be a little bit tricky. One thing I did forget to mention is if you guys want to check out all my holdings, keep track of my trades, all my stuff is on Blossom. There's links in the description of this video. There's a referral link to Wealthsimple. There's a referral link to Blossom Social, social media app that you guys can sign up. There's tons of portfolios. It's a cool app. Like, check it out. It's free to sign up and use. There's a Wealthsimple trade links. There's links to some different affiliate programs that I promote and stuff like that. So if you guys want to support the channel, check out those links. They're all good quality companies and stuff like that. Most of it's just free stuff that you don't even have to pay for. So if you guys want to support the channel and you guys want to take benefit of that, go ahead and do that. Very much appreciated. But here's a quick little overview of our individual stocks here. So as you guys can see, this has shrunk quite a bit since my last video. I have sold some stocks, and again, the idea is I do want to move away from individual stocks and focus on ETFs, and especially as our portfolios are growing or managing different accounts. That's the way of the game. That's what I think I'm going to do, and then I don't have to worry about when to sell a damn stock, because one of the biggest problems I've had is it's very hard to know when to sell a stock, and it's frustrating. It's hard to know when a stock is at its, when to sell it or not. With ETFs, it's simple. You just buy and hold, buy and hold. You can do that with individual stocks too, but still, I find it's just easier with ETFs. For me, it feels better. It's simpler. I don't have to worry about it, and when I'm making multiple different accounts, it's just easier that way. So quick little overview here. I'm going to zoom in so you guys can see, not that much. Let's go right there. Let's see if hopefully you guys can see this. If you guys can't, just pause the video. But once again, all this is on Blossom Social. If you guys want, you guys can sign up, look me up on there, and all the stuff is on there as well. But here's the different accounts. Here's the different tickers we have. Quick little overview here. Wealthsimple is a cool little portfolio tracker where you can see all of your investments across all of your accounts, summarized and averaged up together. So we have things like our list price, our book quantity. So this would be like the net worth of each stock. So we, for example, have $106,000 in VFE. That'd be the book, right? Quantity is how many shares. Average price would be the average price I paid for each share, like averaged out. Income here is the dividends. So I've made $3,000, $436 from VFE, for example. Here's all the incomes. Obviously, the stocks with higher yields will give you more income. All-time gain / loss plus income is going to be the total return. On the right side here, we have the gain and loss from the stock growth or stock appreciation. So you'll notice let's highlight a stock like HYLD, for example. HYLD is an income fund, doesn't make a lot of money from growth, right? You're going to get most of your money from dividends. So you'll see here, my total return is actually 30%, but only 2% is from stock growth, right? Most of it's coming from yield, that $4,000, right? Coming from yield. That $4,910 in gain, $4,520 of it came from dividends. So it's important to look at the total return. It matters, but also kind of understand the difference of the way these stocks work and stuff like that. And that's another reason why I try to buy the covered call ETFs and the split share corps when they drop, because then, you know, you can level off some of that stock depreciation that can happen with these funds. But also if you buy them during the dip, things go back up a little bit and you get a little bit of stock growth too. And it just helps you out a little bit with those funds. So that's a cool little tip. But again, you don't have to do that. It's kind of timing the market in some sense, but I'm not anal about it. I just do it if I see the opportunity, kind of thing. But more or less, I try to follow my targets and my allocations regardless of what's going on in the markets. But you guys can see here, total return of our individual funds, our biggest earning funds is going to be the S&P 500 as well as VDY. Looks like VDY has caught up with the American funds a little bit. 34%, pretty much split across the board, pretty close. HYLD about 30%, HDIV 13%, 20% from FTN, and then, you know, some individual stocks. And I think this TD here is not accurate. I don't think it's a gain of 116%. That might be a mistake there. I'm not too sure what's going on there. Maybe that's in a different account somewhere. Maybe it's like an RSP or something like that, but I'm pretty sure I'm gonna have to double check that and update that one, because that one might not be accurate. But it's a cool little tool where you can just see the total loss and gain, because sometimes when you look on Wealthsimple, it'll show you the total gain from a stock growth or stock depreciation, but it doesn't take in factor of the dividends and the income, because they make a big difference. Like VDY, for example, which is a dividend growth plus, like a dividend plus growth fund, right? You get stock growth as well as dividend yield. According to stock growth, it's only up 21%, but if you add in those dividends, it's up 34, 35%. So it makes a big difference, right? So always kind of keep that in mind. It's a cool tool. Unfortunately, you got to pay for it. Wealthicut's about 10, 15 bucks a month, but I think it's worth it, especially once you start to manage a big portfolio across multiple different accounts and stuff like that. So I can take my portfolios, I can take my fiance's portfolio, right? And we can stick it all in here. And it's a nice little tool to see all that kind of stuff. But once again, one final disclaimer before we end the video. All these returns, you know, they're based off when I bought the funds. They're based off different things like that. So don't look at this for advice on what stocks to buy. Look at stock graphs. Go on Google, look it up, because this is going to be obviously biased towards when I bought the shares, my portfolio. It's not going to be 100% accurate. Definitely go on Google, look the accounts, look the stocks up, you know, see for yourself what the returns are like. Don't kind of take this as, oh, just because a stock's in the negative or it's in the positive doesn't mean it's a good buy or you should buy it. You know, do your research, make sure you guys know, because I know there's a lot of new people who watch this channel on a regular basis. So just kind of keep that in mind. But anyways, guys, that's it for today's video. Just want to end it really quickly. I hope you guys enjoy it. Let me know what you guys think, and take care.